Our next guest says the Fed's stimulus policies have been good for the U.S. economy and the markets. He's Mike Holland, chairman of his money management firm, Holland and Company. Mike, you heard Erica's report. Which do you think is more important for investors, Fed policy action or the fiscal cliff talks?
Right now, Susie, the fiscal cliff talks are clearly the item du jour for the stock market particularly. I think most people expect exactly what Erica Miller was talking about from the Fed, and Ben Bernanke over the last few years has done a very good job at being very transparent and telling people well in advance of what he's going to do. So the $85 billion should continue month to month, building up to a $4 trillion balance sheet, by the way, for our taxpayer balance sheet.
How does all of this play out in the markets? All of that bond buying, companies still, holding off from hiring and spending, and now the risk possibly of a recession. How does this play out in the markets for 2013?
Well, what's happened is that with all of this cash going into the market, not only into the economy, not only from the U.S. Fed, but from Europe, from the central bank there, as well as from China, don't forget. So we've had this liquidity which has taken asset prices, read that the stock market and bond market, prices way up. It's actually helping housing now after a long await. And I think that moving into the future, there will be some reduction in really the fear that people have. It's not only a lack of confidence, it's actually a fear of things going wrong. So as we get day to day here, I think the Fed has been the only place in town to inject some optimism or feeling somewhat better in the general public as well as in business. But until we get through this silliness in Washington, I think people will continue to be cautious.
And speaking of that caution and fear, as you were saying, what should investors be doing with their money? So many of them, not only individual investors, but professional investors, are sitting on a pile of cash. Hold off or invest? I mean, what is your investment strategy?
Well, people, the viewers right now, many of them have been out of the stock market for an extended period of time because of all the craziness of the past decade, if you will. I think some of them probably should consider taking a little bit of their money, putting it into some things that are getting very good current dividend yields. And so stocks around the world, not just the U.S., are yielding more than they ever have. Asia, some huge yields over there. And I think there's some really good properties in the U.S. If you look at Apple stock, for example, well down from over 700 to 500, if you will, yielding 2%. The 10-year Treasury is yielding less than that. It's yielding 1.5%,
right.
1.2%, depending on which day you're looking at. So I think looking at stocks makes some sense. Fixed income markets actually scare me a little bit, the bond market, because it's so low yield, so high priced.
Mike, I want to see if we can squeeze in a question about China, because a lot of investors are wondering about the outlook for China. You just came back from there. A lot of American companies saying that they're seeing a real slowdown. What's your take on China?
There's no question that they have had a slowdown engineered by the government, just as the big stimulus worked in 2008 and 2010-11. They did a slowdown. They said they were going to stop that. They did stop it. We talked to companies, talked to them last week. Business has bottomed out and is in fact turning up. And it's interesting, Susie, that in the past week, a week ago, December 3rd, the most recent bottom in the Shanghai market, which has been a big underperformer despite the economy growing 7%, that market is up 6.5% year to date, including yesterday's small decline.
Right.
So the markets over there are beginning to believe that things are getting better over there as well.
Okay. Time to take a fresh look at China. Thank you very much, Mike. Mike Holland of Holland and Company.